So welcome to the big SMC video. In this video we're gonna go into depth about why the market moves. We're gonna see all these questions you see here. What does SMC mean? How does the market move? Which markets are affected? And let's go over the videos, because after the first three questions we are going over the last videos, not rewatching it, but just see the titles and go into all the Confluences itself, revise all the Confluences fast, and then see why they are important and what they actually do and what they mean. For those questions here, how to connect the Confluences, which hold the highest value, which time frames, combination of Confluences, all of this is first option, your job to do with 100 hours of backtesting like we did. Or second choice, you just ask questions. You just ask us and we will help you. We will not tell you exactly, because you have to find out yourself in some sort of manner, but we can give you hints and explain you a little bit deeper why and why such thing is relevant. But in the end, you have to find out yourself, because when you find out yourself, you build your own strategy and you will be profitable more easily and faster. So, whatever, let's focus on what we explained today. We're explaining about those four questions. So, what does SMC mean? SMC means smart money concept. So, the strategy, the big part of SMC is to trade with smart money. Which is smart money, or what is smart money, and what is dumb money? Smart money is money of banks, of institutions, the big players. I don't want to go so deep into it, but you can just remember the big players. The big players who, close to never lose anything. And we have the dumb money, which is the retail traders. So traders who have not really a clue what they are doing and just try to do anything and just try to get some money from the market. And spoiler, they lose mostly everything. So that's SMC. So now imagine one thing just before we start into the next questions. The market makers, like the big money, the smart money, they are not entering with $10 or 1K or 10K. They are entering with enormous amounts of money. Really, like so much money that they cannot get filled. They cannot just enter the market easily. If we enter with 10K, for example, we just press buy, finish, no problem. We just get filled, no problem at all. But how does actually pressing buy and pressing sell work? So when the stock market first developed, it was like this, really easily formulated. You go there, you say, I want to buy 1 share of Apple today. And then you have to wait for someone who is selling 1 share of Apple, so you can switch. And in this way you can enter the market. You can only enter the market when someone is actually selling you the share to you. So now everything is digitalized and everything is faster. There's a million people pressing sell right now for some amount of money, for some amount of shares, and there's a million people buying at the moment. And then it goes hand in hand. Everything is going to go switched. So it doesn't mean if, for example, someone wants to buy 10 shares of something, there needs to be a person selling 10 shares. There can also be 2 people selling 5 shares, or 10 people selling 1 share each. So that's why when you enter with big amount of money, you have big problems to get filled fast. Because when you enter with $10, there's every millisecond on big markets, there's someone selling something with $10. Because someone who is selling $1 million has so much the $10 to sell you, so you can enter the market, no problem. But if you enter with 100 million, then the problem is bigger, because you have to find people in summation or one guy who sells 1 million or 100 million, and that's a big problem. So that's why the filling, yeah, is not so easy and is way slower. Just keep in mind, this is really simplified. It's not 100% accurate of what's really happening, but it's simplified for you to understand. So now there is the smart money, and the smart money enters with enormous amounts of money. So they have a problem to get filled, because at some points in the market they can get filled because there's a lot of action happening. Because you can imagine, if you have an uptrend, for example, and it's like this, there's a lot of retail traders acting here on this part, because they think, oh, we go lower or we go higher. There's a lot of action happening here. But if you enter on a random time, for example here, there's not really much happening here. So there will not be so much action here for the big money to get into the market. So we have to find some sort of place or time in the market where the big money actually can enter the market. And the big money, the smart money, will always enter, because they will always make money. They never lose, they catch all the big moves. So they are always in the market. So the big problem for them is to go into the market. That's a big problem. To fill as much orders as possible, to catch the next move with a lot of money. So now just keep this in mind and let it rest for 1 minute. And we go over the next questions. How does the market move? Okay, there's 3 main parts why the market moves. The first one is orders, so liquidity. If you want to revise quickly what liquidity exactly was, go back to the video, go back to the liquidity video and check it. So the first part is liquidity. Then the second part is imbalances. Go watch the video for fair value gaps and inverse fair value gaps. That's imbalances. And manipulation. We don't really focus on manipulation so big, but especially in Trump markets now, there is manipulation, which is like just really overextended movements. For example, about the tariffs. Yeah, Trump posts, okay, we have tariffs on China, and there's an unexpected move coming, which is so manipulative and has not really something to do with the market. Really, it's too aggressive. So let's focus on the 2 parts: liquidity and imbalances. Okay, we keep this in mind first, and then we go deeper into it. And which markets are affected? This is pretty easy, because the answer is every market. Indexes, gold, silver, crypto, even the coffee stock, yeah, the wheat stock, everything moves because of this. Every market moves because of imbalances and liquidity. There's nothing more. Yes, there are some people saying, oh, the market moves because of an imaginary wall I drew into the chart, and now we are bouncing and the head is hitting the wall, and yeah, whatever. Come on. Because we are not 5 years old. We don't draw a line and hope that the chart is bouncing from the line. Yeah, come on, there's no real sense behind it. So now let's go over the videos and go over the explanations. I go into the Discord, into the skill building category, and we're gonna see. So the first video was general and candles. We can skip this basically. Then the second one is order flow and break of structure, and the third one is liquidity. So let's combine them to make it easier. So for example, yeah, let's search for a good example. Let's go to yesterday actually. Let's just focus on yesterday and show you in this way that it's not a perfect example. We just go to yesterday and see what happens. Okay, so I go back to yesterday and we're gonna see. Now we try to get together all the Confluences we learned. So we know there's New York session opening here. We know that there's London session opening, and we know that there's Asia session opening. Okay, if you want to revise again what they said, what the sessions do and why it's important for us, just go back to the video. So we see there's this move up in Asia session, so there's a high right here. Okay, the Asian high. We have the London high right here. We have the London low right here. Okay, so far so good. We have a 1 hour low right here. Yeah, move down, move up. Okay, no problem so far. So let's see. There will be a move in New York session. Most likely in New York Open, because there's the most volatility. There is the new money, the smart money flowing into the market. Is it possible? Let's go here. Now the market opened. Is it possible for the market makers to go all in to catch the big move for the day here? Not really, because as a retail trader, as traders who don't really know anything about the market, this is random. You know, this is random place. There's no real confluence here to enter the market, because as a retail trader you see maybe lines. You maybe see some sort of this. You maybe draw this line. We didn't get a breakout. There's no real place here for retail traders to enter, and so there's not a lot of dumb money entering here, which the smart money can use to make the move happen. So where is the time that a lot of dumb traders, retail traders, want to enter? Most likely, if we get a break above here. For example, if we go above here and they think, okay, we may get a retest and then go higher to this resistance right here. Maybe. And also another opportunity is, for example, they see, oh, well, we have this line right here, this trend line. Okay, maybe, oh, well, I do it I do it clearly so you can see. They see maybe this line here. They say, wow, this is a perfect trend line. Or maybe they see we may form a triangle here. So if you hit this line, I can go long. Okay, well, we see. What happens? I will keep this line actually. I will keep it so you can see better. This is our line for now. For example, this. Okay. So now they wait for the line to get hit. Okay, what happens? Oh, we hit the line and we get a reaction. The retail traders, they long here. And maybe go up here or up here. That would be the trade. And just a stop loss below the low. That's it. But is it actually a good time to long here? Not really, because it's just a line. And we have no real confluence. We have still a downtrend right here. Not even on the 1 minute. We changed the structure of this downtrend to an uptrend. We didn't even break structure. So we wait and we see that this reaction of this imaginary line, yeah, well, you see yourself, they lose. So now what's happening now? Now it's happening that we are actually breaking this support. The retail traders, they see this as a support, and now we are breaking the support. So what are the retail traders doing? They short, because they think, well, we broke this support, now I'm shorting. Okay, well, so now here in this time we have a lot of people shorting. There's a lot of shorts here. So if there's a lot of people now selling shares, there's also a lot of opportunity for the big buyers, for the smart money, to buy shares, because there's a lot of shorts here. Okay, this is the first important thing. And the second important thing, we have this low and this low here. There's also a lot of people who want to buy here again. Because we saw some kind of move down, and this is the last resistance, and this is a resistance. So people want to buy here again. So that's why the market moves here. Okay, so ever. whatever, we have a lot of shorts here. So the smart money can enter a lot of longs here. So they enter right here. That's why this is called liquidity sweep. Because there's a lot of liquidity, a lot of orders, a lot of action happening right here. Because the people also who went long somewhere around here because of this move up, where's the stop loss? The stop loss of them is below this low and maybe below this low. So they get stopped out. Okay, so what's happening around this area? First of all, we have limit orders. Second, we have stop losses and we have people going short. I think this is clear for now. So people where the stop loss is triggering, now there's free shares again because they, for example, bought 10 shares and now they're stopped out. So these 10 shares are free again for someone to buy. You know, it's simplified. And there's people selling here because we broke this support, the retail traders. So there's two big points here. There's a lot of shares free who can be bought. So the smart money, the institutions, the banks, they buy here, like really enormous amounts of money. So, but how do we know if they buy here or here or here? So yes, when they buy here, we can expect a move up. But how do we know if the move starts from here or from here or from down here? You know, how do we know? We know because we can scale down to the lower time frame and see the market structure. Because here we can see we have a downtrend. But in this candle right here, we broke actually structure to the upside. Okay, that's good. So now there can be a change of the trend to the upside. So we have already two confluences. We already know that there's the market makers probably entering somewhere around here because there's a lot of opportunity for them to enter. Did they enter? Most likely yes, because we got a break of structure to the upside. Okay, now let's see. If there's a break of structure to the upside, then we can expect, I delete this and this, we can expect that there will be some sort of reaction to the upside. Okay, but now important. Here there was a lot of buy orders. If there's a lot of buy orders from the smart money, then what will the chart do? It will be explosively up again. You know, it will not spend so much time down here because if there's a lot of time down here, then the dumb money can enter again. And how can the smart money work against the dumb money? How can the smart money somehow get the solution for the dumb traders, the retail traders, to make money? They can make the perfect entries as fast as possible. So we go down, we break structure basically immediately, really fast. Okay, so what is the problem here? If we break structures so fast and we go up so fast, what can happen? The enormous amount of money of the smart money cannot get filled because it's so fast. For example, smaller digits, but for example here there is $100 free of shares at the moment to buy. Now the market makers, we go here, and the market makers, they want to fill actually $1,000 of shares, or 1,000 shares. But there's only 100 free right here, so they can only fill 100 of their 1,000. So that's a problem for them, because they want to catch this move with all the money they have, basically, to make as much money as possible. But they cannot, because there's not 1,000 shares here free to buy. So what's happening here? Well, we have an order block right here, right? You know this. We have a breaker block right here. You know this. Yeah. We have equilibrium here. You know this. Wait, let me check it correctly. You know all this. So I delete this for a second, but here there's in this in this box there's a lot of orders still lying. For example, if you go back to the digits, there's 900 orders from the market makers which they want to fill, still unfilled. So if the move happens now, they only make 1/10 of money they would have made if all the orders are filled. So what is happening here? We go sometimes down again, fill these orders, chop here a little bit, and then go up. Now if you watch the video again for order blocks and breaker blocks, you will see this perfect example I showed there about the consolidation inside the order block. Because the longer we stay in the consolidation here in the order block, the more orders they can actually fill. You know? And that's really interesting for us to see. What happens now? Oh, we go back into the breaker block, we go back into the order block. Did we touch equilibrium of this move? Well, we touch equilibrium. What a coincidence. And now we get a reaction out of it. We get a bullish reaction out of it. Okay, that's good. And now one more thing. If we have a downtrend, remember fair value gaps. There's fair value gaps here somewhere, and we fill it and we go lower. So if we inverse this fair value gap, if we go above this fair value gap, this can be an indicator of us going higher, that we change trend. So what do we see here? We see a fair value gap. Okay, and we inverse it, we close above. So now with this type of trade, what do we see? We saw we have big support down here. The retail traders, they see this. Support. Okay, we broke the support. We saw this actually, that we broke it. Yeah, right here. We broke the support. So a lot of retail traders short here. And the people who went long in this move and have their stop loss below this support, they get stopped out. So now there's a lot of people who are selling. And the market makers can buy. So this is an interesting area for us, because here the market makers could actually enter the market and make a move to the upside. How do we know that the market makers are entering here and are interested to move the market to the upside? We check the lower time frames. And we see, okay, we have a downtrend here, and the downtrend actually changes with this candle. Okay. So now we can see the order block right here. We can see the breaker block right here. We can see the equilibrium fill right here. We go back to make people believe, well, we respected this fair value gap and get a bearish reaction route. I can short again. It's a retest of the support from the downside. And this support turns into resistance now. No, it's not. Just wait. We test the breaker block, we test the order block, we test the equilibrium, we get a bullish reaction out of it, we inverse the fair value gap. Here we can long. Okay. We can long, and we can target this low resistance liquidity right here, and we can target the London high. And we can also target the Asia high, for example. Yeah? Because how can the market makers exit the market? They want to sell enormous amounts of money. How can they exit? Because they need people to buy, you know? If they want to exit $1 million, there needs to be people who buy $1 million. So where are retail traders most likely to enter? Well, they are most likely to enter if we break this resistance to the upside, or if we break this resistance to the upside, you know? So here they can actually exit the market. So what happens? We can go down and we can see. We go up to seek out the London highs. So here we actually went above this little resistance here. Retail traders, they are ready again to long here, because we went up over this resistance here. This resistance, this here. So they're long. Stop loss, I don't know, somewhere around here. And let's long to the next resistance. Well, here there's a lot of people longing, so what can the market makers do? They can short. So what happens? Oh, the retail traders get stopped out. The market makers profit from the short. Okay, we go down again. We failed. We failed to go above this resistance. Okay, we may go down. We may go down again. Let's short retail traders. There's a lot of people shorting here because we bumped our head to this imaginary wall. Okay, so what can the market makers do? They can long again. What happens? We go up, and the retail traders, they lose again. Where do we want to go? To Asia highs. To seek out all the people who are in short. I think now you understand a little bit what I'm trying to explain you with SMC, because if you see here, the market did not really move. Not really. But the market makers made huge amounts of money because it just make the dumb money stop out, 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 all the time. All the time. And they make money, 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 make money. Right. That's the only thing happens. So we wait for times where the institutional money, the smart money, enters the market. We wait for confirmation that they actually entered and we trade together with them. Because if you trade against them, you lose. So every time you lose, it's your mistake to not see correctly if they entered and to not correctly predict when the other people lost. And if you don't take profit good enough, then it's your mistake because you thought that the profit taking will be different from the big people. Because you have to think in two perspectives. You have to think first, how will the smart money win? How will the institutions trade most likely? And the second view is, how can the retail traders, how will they lose the most of money? Where will they probably enter? Okay, they're probably entering here, so somewhere around here needs to be my stop loss. For my trade. This is the two perspectives. So this trade was perfect to explain, really. It's not always that easy to just scale on the 1 minute time frame and see everything this perfectly. So that's why these questions, how to connect the confluences, liquidity sweep, break of structure, order block, breaker block, equilibrium, fair value gaps, inverse fair value gaps, how to connect them correctly. This is not always like this. It's not as easy as it was here. This is hard and you have to spend a lot of time in front of the charts or ask us and we're gonna help you. Which time frames hold the highest value? We had a change on the 1 minute time frame, but not on the 2 minute, not on the 3 minute, not on the 5 minute, not on the 15 minute. Which time frames are the best? And where to trade? Which time frames are most relevant? Is a 2 minute break more relevant than a 1 minute break? Normally, yes, we learned higher time frame, higher power. But if I wait on the 2 minute break, then my trade is not good because the risk to reward is not 1-to-1, for example. And how can I combine the confluences? Can I combine a liquidity sweep directly with an inverse fair value gap? Is it better to wait for a fair value gap and then for a break of structure? Which confluences comes first? Which confluences are most relevant? All these questions you have to find out by yourself, or you can ask. Ask, send us pictures of your trades, ask what's wrong, what could be better, and so on, and we help you. Maybe if there's a lot of questions, we will do some sort of category inner circle, maybe, where we just, bring together really serious people and you can ask us everything you want. Everything. You need help in connecting the correct time frames, connecting the confluences, understanding something deeper about SMC. You can ask us everything there. So if you're interested in this, then just let us know. And that's it for the skill building category. This is the last video actually. So I hope you understood about smart money concept now. You understood the why of the Confluences and why we are trading SMC and why we are teaching SMC. And yeah, I hope it makes a lot more sense now for you. So I'm happy that maybe you can get some sort of feedback for us about this video series. And please let us know in some sense if you are interested in some sort of category like inner circle, where we just are a smaller group and you can ask us everything you want. If you have problems with specific things, just let us know. If you have any big questions or just one or two questions, no problem, just ask in the general question chat. If you have really big questions or a lot of questions, um, yeah, then tell us that you're interested in some sort of inner circle category and we will talk about it and maybe we'll do one. Um, so yeah, that's pretty much it about skill building. I hope you can remember all the confluences. You remember and you also understand why they're here and what it actually means and why. Um, yeah, and that's pretty much it. With this information, you can surely understand all the recaps. Of course, this is not all. There's a lot more things that we didn't even explain. You know, highest time frames, inversions, SMTs, and so on. There's so much other things which can help you in your trading, but this is just a quick overview. For all these things, this is also interesting for the inner circle category. But let's focus on the overview, and the start into trading you can get with this skill building category. So have fun, enjoy all the videos, maybe watch it twice or three times, and then go to backtesting and ask questions. It's the most important thing. Backtesting and asking questions. That's it. So I hope the way is gonna be fast for you, and I hope you understand everything correctly. And it was, yeah, in some sense also a little bit entertaining. So that's it for skill building, and see you maybe in the next video series, maybe in the next recap, live trading, whatever.